amidst all of this, there are a lot of numbers that have been coming in thick and fast as well. So for the first management that's joining us on the show today, Blue Star, despite weakness coming in, the numbers were in line because the street was largely prepared for these numbers. It was an unseasonal rain and a short summer. We do have the chairman and managing director Veer S. Advani joining in to decode the quarter gone by. Mr. Advani, thank you so much for joining in. And understandably, it was a quarter that was marred by unseasonal rains as well as a shorter summer. If you could give us a sense that after all of this that has happened in the first quarter, do you still stick by your annual guidance, or do you think you will revise it lower for your UCP and room AC business?
Morning. Thank you so much for having me. You're right, it's been a weak quarter, actually a weak quarter after many strong quarters for the company. Overall, revenue grew 4% to 2,982 crores. EBITDA dropped by 16% to 200 crores and PBT dropped by 28% to 163 crores. As you rightly pointed out, the degrowth was quite severe in segment 2, which is our unitary cooling products division. Actually, segment 1, which is our B2B business, grew well, 36% revenue growth and 11% EBIT growth. It was segment 2 that got...
Mr. Advani, we have these numbers. They're publicly declared. What we want to understand is at the start of these, at the start of the year, when the summer prospects were looking fairly strong, in fact, at some time, scarily strong, so that, there would be limited supply as well for you guys. That turned around and you were targeting 20-25% growth for the full year with 8.5 to 9% margins. Do you retain that after what has taken place in the summer?
No. So we will not be able to make up all the lost business of Q1. When you have a lost summer, it's difficult to make up for the full year. But what does happen is that the second half of the year typically will be stronger than what we had.
So full year, what does your guidance now stand at as you see things for the revenue and margin, standpoint?
Yeah, so I think against that 20-odd% growth, I think we should be able to do about 10% growth. And on the EBIT side, we should be able to get to that 8.5%.
All right, so EBITDA margin guidance downgraded from 8.5 to 9% to 8 to 8.5% on the back of revenue growth lowered from 20-25% to about 10%. That's right?
Yes.
All right, Mr. Advani, you want to break it up for us segment-wise?
Sure. So sorry, that was about segment 2.
Okay.
Yeah. So what we're looking at is a recovery in segment 2. We will not be able to deliver that overall growth rate that we had wanted, but we do expect the festival season to be better. And as you know, there's a BEE table change that happens on January 1, 2026, which will also fuel some purchasing in Q3, and that'll go into Q4 as well. Segment 1, actually, of course, you've seen quarter 1 revenue growth very strong at 36%. I don't think that's what will happen for the full year. It will be in line with what we have been guiding for about 20% growth overall, and the EBIT will be about 7 to 7.5%. What happens in segment 1 is that you have business mix changing, right? We have a projects business and then we have the commercial air conditioning equipment business. Both contribute to that segment. In Q1, the projects business grew a lot faster, which is why you see revenue growth much faster and an EBIT drop. But on an overall annual basis, we should be at last year's level of 7 to 7.5%.
Okay, all right. What about market share? I think you had a target of 15%, right, by the end of this fiscal. That's on?
Yeah, so we closed this quarter at about 14%. If you look at GfK data, you'd have seen that even though the market has degrown, we have degrown less than the market, which basically implies that small market share growth. So that is on track. We continue to, 15 is the target, is where we've been looking to get to. We've just crossed 14, so we'll keep working hard to try and get to that number.
All right, and finally, before we let you go, on the second half of the year is where you make up for some part of the lost summer, but that also entails that you'll have to do a hard push. If you could give us a sense of what's the inventory which is lying in the channel right now, how does that compare with the usual times, and will that mean that there would be higher discounts and perhaps lower realizations for you to liquidate that inventory as we move towards the festive season?
Yeah, so we have not done any discounting to liquidate inventory. We've been quite fortunate that our tertiary sales have been strong. And so between the channel and our warehouses, we're holding about 75 days of inventory. In a normal course, it should have been about 45 days. So there's about 30 days of excess inventory for Blue Star in the field. We are confident that we'll be able to clear that out. As you know, because we're doing all our own in-house manufacturing, we were able to stop production in a timely manner, which typically you would not be able to do if you're buying. So because of that control, we are not so worried about the inventory. That should clear out. It is more about, like you said, the second half demand to recover, and we do need to push primary sales through our channel. We're quite optimistic about doing that. We're increasing market share in the north as well as holding fort in the south. So we're quite confident that we should be able to close the year on a positive note.
All right, take that point. Thank you so much for joining in and giving us this perspective. Wish you a better second half of this year as well. But let's talk.